Well, it's 1 o'clock, so we're gonna try and stick to the game plan here and get through as much as we can today. So just a couple information ground rules of how we plan to do this thing. So open Q&A, any questions related to either a deal or strategy that you'd like to go through. There is a Q&A box at the bottom of the Zoom screen there. If you type your question into that, you can type it in anonymously or you can type it in with your name. It'll show up on our Q&A panel here, and we'll answer that. So that is our goal, is to be as transparent as possible and as helpful as possible as we go through all the different types of deals that we currently have. Ready to go?
Ready.
Okay. So first thing we want to just start off with and talk about is just general feedback over the years and how that has helped us evolve our acquisition strategy, our management strategy over the years. So consistent distributions is something we have always heard as feedback. We hear people when they're saying, look, we want consistent distributions more than anything. And we've done a mix in our career here at Greenleaf. We've done a lot of value add. That has really been our number one investment strategy, is to buy something that's needs some love, as we call it, fix things up, create that value, and either try and cash flow it or sell it or refinance it. We take one of those approaches. That's always been our game plan. And then around really 2018 is when we got more and more feedback of consistent distributions. That's when we started our retail business with Andrew.
Right. Yeah. But prior to that, it was all these really, really distressed apartment buildings that were very unreliable in terms of performance until about 2-3 years. Then we refinance, put fixed rate debt on them, hold them. And then the market just kind of took off. So we ended up selling a lot of those. The ones we held have been fairly consistent distributors since.
Yeah.
But retail, since day one, the goal was out the gates, consistent distributions, and we hit every quarter.
There's a very small value add component of retail. It is mainly how are we going to have a tenant that can make a consistent quarterly distribution. We do not have significant reserves there. And we also do not have a significant operator cost that's associated with them. Most of them are either double or triple net leases, where the tenant is absorbing the majority of those costs. They're managing it on their P&L. So a very consistent, accurate to budget performance with not many variabilities of going up and down.
Right. And then as the years went on, over the last 12 months, we saw the opportunity to, how do we do even more consistent distributions and go from a quarterly to a monthly opportunity? And that's why we brought on the debt platform. And we're excited. We did 8 deals last year. We have quite a few teed up for the beginning of this year, but it's really been a unique opportunity that the banking industry has softened quite a bit, that they're not really lending. And so we took advantage of that opportunity and started putting together packages to help other operators.
Yeah, really, our goal there is just monthly consistent distributions. There's, on the debt side, there's really no upside potential. It's just consistent monthly distributions. That's the name of that game. That's what we're aiming for and hoping for when we execute those deals. And we're trying to make sure we do them with the right people to enable that to happen. On the other side of that spectrum is the value add side. And that's where we're trying to find opportunities to go do a mix of physical and operational work to add value to an asset. Every time we do those deals, it's almost impossible to do a value add deal and then from purely operations, just immediately day one, catch up and pay all the back preferred returns. That's not the model, even though we call it like, what's the preferred return or the hurdle rate? That's not something we can do in a value add deal. So if it takes us 18 to 24 months to turn something around and get it stable, starting at that point, we can't just go back and pay all the deferred preferred returns, because it's just not going to make that much in cash flow. So those deals, we always have to get to a point of saying, are we going to refinance this thing? Are we going to sell it? Or what are we going to do to realize that value? Or are we okay with the cash flow that it does produce at that time? And that's why you see a lot of our apartments deals we've held 8, 9, 10 years. It's because they have continued to create cash flow. We've been satisfied with the cash flow they produce.
Right. Also, just going back to the value add story is, our modeling, our pro forma is really a projection or an estimate based on our historical averages for similar deal types. So a good example is Dawson, right? It's like, there's a property we bought. It was I think one of 3 buildings was occupied by the seller. The other 2 were vacant. We started renovating them and immediately got 2 phenomenal leases. One of the leases took us basically a year to sign and execute, and then we had to build it out. And they're finally going to start paying rent about 2.5 years later. They're going to start paying rent in the summer. The other lease, another fantastic lease, went defunct in 90 days?
Yeah, I mean, they said they'd move in right away, but it didn't work.
Yeah, so
they
it
ended up moving out.
It took us 3, 4, 5 months to sign that lease, and then 90 days later, they were no longer paying. So we had to do that all over again with that building. So the averages don't always work out to be exact, but the vision with the value add buildings that we're creating a lot of value by releasing, by repositioning the property, by putting new lease structures in place. And we're going to talk a little bit more about what those lease structures look like, and the value creation will be there, but the cash flow can't always catch up to it.
We have our first question in too. As before we get into kind of the asset classes, we're going to go through each asset class. We're going to go through debt, we'll go through retail, our commercial assets, and wrap up with our apartments. So our residential stuff, which is a mix of mobile homes and apartments. But question here on the QOZ structure. So again, we bought 6 deals with our QOZ fund, and the question is, if we're looking to sell Fairway in the second quarter and performing broker opinion on Graham, which is up in Charlotte, what are the investor options at this point? And I assume you'll not take profits and reinvest into the fund. Will you need to redeploy the capital into another QOZ property? So the QOZ structure is that the gains are tax-free if we hold the funds in the QOZ fund until 2029. So we could buy a QOZ qualifying deal and sell it and invest in another QOZ qualifying deal as long as it stays in the QOZ fund and in a QOZ asset until 2029. So that's our goal. So Fairway, we are looking to exit that residential apartment deal. If we do that, we'd really have 2 options. We could return funds to investors, but at that point it would be taxable. There's not really a 1031 option from the QOZ standpoint, or we can continue to deploy them into QOZ assets. That can be any asset that's in the QOZ zone in that map district, and then it maintains its really, I would say, tax deferred status until 2029 when it becomes a tax-free gain. So that's how we plan to keep working with the QOZ fund. That's been our goal from day one, is really make it to 2029 to realize that ultimately deferred tax to tax-free status on those gains. So first thing we're going to do is we're going to talk about our debt deals. So let's go into, we did a bunch of those this year, 2024.
So, the majority of the debt, we did a handful with Epitome out of Houston, Texas. They own a lot of land between Houston and Austin. They've been a great partner. And really the strategy here is more longer term, which is that we can get involved at really the base level of, say, raw land and lend them some money. And then we'll have a stage to really exit with them when they go to horizontal development. So that'll be kind of the first off-ramp for us if we'd like. Or we can lend to them on horizontal development, which is step 2. The next step is basically going vertical, which would be the step 3, which we can take the off-ramp after horizontal, or we go vertical with them and start building some stuff. The different stuff, they're mostly doing single family homes and developing lots for single family builders. But there's a couple sites that have an industrial pad, a retail pad, or a multifamily pad that we might be interested in going vertical with them. And it's really just building a pipeline and getting to know them.
Yeah. And what's unique about the situation or relationship with Epitome is, I think debt funds are maybe one of the key words of 2024 that people are like, hey, everyone's doing a debt fund. And what does that mean? A lot of that was around rescue capital for mostly residential office deals or something that wasn't working. It was like, okay, how can someone step in and lend money as rescue capital for a deal? So we're not doing any of that kind of lending. That's not what we're interested in. We are only working with sponsors that have a track record and that we have a personal relationship with. So we're not going out advertising as a debt fund. We are not looking to provide rescue capital. We're not looking to bail anything out. That's not really what our position is on it. So again, we kind of put stuff in our own our own thesis of how we plan to execute. That does limit us from doing a whole wide array of things. So we have a narrow pool that we're looking at focusing on, and that's where we really think we can have good returns and good longer term prospects with these situations, just like Epitome,
Right.
and keeping going on the various things we could do with those opportunities long term.
Yeah. In addition to that, as our own deals come up for refinance and renewal, we're looking at, okay, do we sell? Do we refinance with the existing bank? Do we go find another bank, or do we just raise our own capital source like we did a handful of times last year?
Yeah, in one of our deals last year, the loan was coming due. The interest rates are already pretty high. There's a bunch of fees and costs associated with the bank. So we just did it ourselves internally and offered it to the investors on that deal.
Right.
Yeah.
So we're really trying to be more of a lending partner than a true, I would say, debt,
Yeah.
I don't know, vehicle. Yeah.
Right. Yes. It's not a debt fund in the
Right.
advertising sense. One of the questions we had that came in was, are you always getting a personal guarantee when you do issue debt? And the short of that is no. We're normally getting sometimes we're getting a personal guarantee. We're always getting a business guarantee on it, or it could just be backed by the specific asset that's there. So we did a loan on an apartment deal where it's a first position, 20% loan to value. So no, there's not a personal guarantee on that. However, we're first position on the real estate, and we like that spot.
Right. And sometimes business guarantees are much more valuable than personal guarantees because people can structure their estates in different ways. But the business is the business. So we really look at kind of the whole picture and where our best position is, also what's reasonable for the borrower as well, and the best way to underwrite it.
So another question we had here was the discount notes deal that we did on the debt side, and how is that performing? And it seems to have variability in distributions.
Mm-hmm.
So the answer is yes. It has different amounts that it is making on a quarterly basis. That is for sure. But this deal is unique in that it's not really one piece of debt. It's like
I think it was 60, maybe 63, somewhere in that range.
Individual pieces that all have different repayment terms, and sometimes they're getting paid off early and we're getting return of capital from them. So it makes for very variable income streams coming in, which is then what we distribute.
Right. The group that we work with is called Discount Lots, and they guaranteed the note payments for the first 3 years of us doing business together. We're about a year through it. We had a handful of lots that either prepaid or really defaulted in some way, and they've replaced those. Some of them they've paid off. So we really had a wide variety of responses, but for the most part, it's performing well. It's just there's some variability in what's happening behind the scenes.
Yeah, and their business is interesting in that they're selling a piece of land. If someone doesn't pay on it, they're taking it back,
Selling it
again. And it's a little bit like if you've been with us for a while and how the mobile home segment works. Sometimes you're selling a mobile home. A lot of that, activity can still happen too there.
Right.
Okay. Our just general investment thesis on the debt side, right? So kind of where this segment of the business is going. We expect this to continue as long as interest rates stay sort of elevated-ish. Interest rates aren't off the charts, but they're still higher. And as long as banks are being slower to work with and still have pretty hefty fees.
Right.
That's kind of like, as long as things stay how they are right now, which looks like they're doing, we see a pretty solid pipeline of debt opportunities and monthly distributable cash flow.
I mean, for a value add deal right now to get a bank involved, you probably need a broker to find that bank. So that's 1%. The bank charges 1% to close a loan. Then they're going to charge you at least somewhere in the neighborhood of 7 to 7.5% interest. There's going to be a prepayment penalty if you exit that loan too soon, and you only get 35 months on the loan to begin with. So it's the layers and layers of fees that are involved here. It makes our debt, which is not cheap debt, but it makes it look really attractive because of the simplicity involved.
Okay, that is our recap on the debt stuff. I'm going to see if we have any. There's no questions that come in on that. We're going to keep going. But I'll give it a second here if anything pops in. We're gonna jump over to the retail stuff.
Yeah.
next.
Real quick plug. So Andrew can't be with us today because he's down in Florida. We're hosting our first Florida event in West Palm Beach tomorrow. So if you're in Florida, you're around the West Palm Beach area, or you want to come visit us, we'll be at X Golf. It'll be a lot of fun. Andrew and I and Steven will be there. And yeah, be a lot of
There's
fun.
a long drive contest.
Yeah, and there's a long drive and a putting contest.
Cool. All right. So retail. So like we said at the beginning, we got into retail really so we could have stable, long-term distributions. We've then realized value creation in the retail side each time we sign a new lease. So when we sign a lease and we extend that lease, at that point in time, we're going to look at, okay, should we sell this? Because that's when they're worth the most money, when they have the longest term lease, or should we hold it for the cash flow that it produces? We're signing typically two types of leases, either triple net, where it's full pass through and the tenant there is responsible for everything, or like a double net situation where we're paying for some odds and end costs. Sometimes that's, we got to pay for a strip of landscaping. Sometimes it's, we're responsible for the parking lot, or we're responsible for a roof, or there's different terms that get negotiated in those kind of leases. So we have those two types of leases across the board. Right. So first question came in here around Applebee's, which our deal that's in Sumter, South Carolina. The question on this was that, how is this performing? And it looks like the placer foot traffic in surrounding and maybe surrounding area is not doing as well. And really, what is the investment plan there?
Yeah, so Applebee's, right about shortly after we bought the Sumter property, and also Seneca, the Applebee's in Seneca was the same thing that we own, was sold to a new operator. They bought, I believe, 76.
What was a corporate guarantee?
Right, with a corporate guarantee, but a new
From
operator in
Applebee's.
place.
Right. So it was a corporate guarantee from Applebee's, and then Applebee's sold it to a new operator.
Exactly, and roughly 76 locations sold. So it was a pretty monster sale in Applebee's corporate. And since that new operator has come in, they've changed the way they do business a little bit. Not, it's still Applebee's brand. They're still operating to Applebee's, way of doing things, but they're putting their own spin on things. And some stores have, where Seneca, for example, was doing well and now it's doing better. Sumter, they're rejiggering. It was doing, I would say, better than mediocre, but not great. And now it's really going the opposite direction, and they're determining really what they want to do with the store long term. We still have 3+ years left of the lease, so we know that, they know that there's a corporate guarantee, so they're paying their rent and everything's fine on that end. But we're also kind of leaving the door open, saying, okay, you guys need to turn the store around. If you're going to sign a lease renewal, let's keep in touch with this operator and see what's going on. And also, just in case that doesn't work out, we need to know what a backup plan would be for the spot. So we've been talking to some other operators for different brands in the area to see, what could possibly go in the store, what's in demand in this area. And we've had some interesting conversations, but no immediate changes, more just on the 3-year horizon. Either this operator has to turn the store around for their renewal, or we need to find a new business to go in there.
Yep. That's our plan. Mm-hmm. We've got a little over 3 years to work through that. And with the corporate guarantee, we feel good about the position it's in right now. So, but yeah, it does have the placer data there is not, we want to see I think anything you invest in, you want to see that it keeps performing better and better. But this one has not performed better and better on the placer data. And they're not in the top half. They're not in the top 33%, which is what we want to see. So next question was, do we envision selling anything this year? And if so, which deals? And there's not an exact yes or no on that. It's more, we're always going to have that discussion around a lease renewal. And once we actually get the lease renewal signed, not a theoretical, hey, this could happen. It needs to be signed. It needs to be in the door. It needs to be, hey, yes, this is something that happened. So one of those that just happened was our DG Sevierville. So of all of our retail deals, DG Sevierville was a double net lease. And then this past quarter we did not make a distribution this past quarter because we were responsible for a plumbing leak that was in the slab. On the lease terms, that fell on us. This was something where they had an in the slab Y pipe formation going not the way a Y should go. A Y should be 2 going into 1, not 1 going out to 2. obviously makes for an easy area for things to clog. So I had to dig that out and fix it. And that's why that deal did not distribute. But other than that, the deal is working really well. And then on that one, we signed a new 5-year lease extension there with a 10% rent bump. That's really the standard Dollar General model, which is great. So now we have the best lease we could really have on that Dollar General. And most Dollar Generals that we're dealing with are 5-year. Some of the newer ones are 10 or 15, but the ones we deal with are 5-year leases. So right now we have our highest and best value. So it's like, okay, do we want to get a look at what the opinion of value is here, or do we want to hold it and keep the cash flow?
Right.
So do we plan to sell stuff? Not necessarily. Everything's making good cash flow. We plan to keep those and keep realizing the distributions. But we do have a lease that does come up. We do actually sign it. At that point, we'll look and say, hey, are there any good buyouts out there that's going to get us a high teens IRR? And maybe we take it.
Right. And really what it comes down to as well is, the point on Sumter with the placer data, right? If we see declining placer data, which is basically declining store performance, but we also get a renewal, that'd be a good opportunity to sell, right? 'Cause we're seeing, declining performance. We just got a nice long renewal. Let's move on before this becomes more problematic.
Yeah, definitely. That's retail. Retail was pretty darn stable and cash flowing. So lots of distributions, which is really why we focused on that and started buying those a couple years ago.
Right. So as we go into commercial here, the big discussion is that Dave started talking about with retail was really comparing that double net or the lease structure, the double net versus the triple net lease structure. So a lot of our commercial deals, when we buy them, the strategy is that we're buying these full service leases. That basically means that they're paying a gross amount of rent. Let's just call it $20 a square foot. Inside that $20, the landlord, us, is responsible for really paying for all the costs, all the bills. And there's really no inflationary protection there other than a 2-3% annual increase. Well, our business model is to buy buildings with those full service leases and convert them to triple net at a reduced rate. So instead of paying 20 full service, maybe they'll pay 12 triple net, but they have to absorb all those additional costs of the electric, the taxes, the insurance, and the inflationary growth of them. And it protects us a lot as a landlord.
Yeah. And then especially like utilities.
Right.
We want people to care how much anyone's spending on utilities.
Turn the lights off at night. Yeah.
Turn the lights off. Exactly. Yeah. But try and put motion sensors and everything. It's just those minor things that really, really add up. So, okay. So that's kind of like that's our general strategy. Our amount of CAM reimbursements that we basically started out with when we started getting into commercial, most of our deals were 0. And now we have over $5 million of annual CAM revenue that's coming back from changing our lease structures and making it more matched with what the current state of the market is.
Right. And that really equates to about around $3 a square foot of additional revenue that these properties did not have when we bought them.
Yeah. Okay. See if there's any. Yeah, so if you have any questions on the commercial stuff as we go through these, please just drop that question in there and we can talk about deal specific. We have some questions that came in on some of these deals. So we're going to go through just really it might sound like the nitty gritty details, but they're very specific to each project. So yeah, if you have anything else in there, please let us know. First one is a question on Johnson Square. And the question is really, we're fully occupied here, but we're not able to make the full preferred return. So what is the investment plan here on this deal? So Johnson Square, that's correct. We're 98% occupied. This deal's right here in Atlanta. We continue to lease up aggressively and continue to extend our weighted average lease term. That's really one way we see the most value creation in a deal is the longer we can get that weighted average lease term, the more the deal is worth. The better we can get leases so that they have shared CAM costs versus just full, we'll pay all the utilities. Also improves that value, and then ultimately it has to be occupied in producing revenue. So Johnson Square, 98%. We bought it at 68%. And coming up in January of 26, our loan does come due. So we have another year. But really, we've reached the culmination of the business plan at Johnson Square. We stabilized the deal. It's fully occupied. And now we have to assess the 3 scenarios in 2025 of what we're going to do with it. There's only 3 options we can do. It's We sell the deal and realize the value. We look to recapitalize it, get a new loan, whether that's another 5 to 7 year loan, see what the debt market will provide. At that point, if we can return capital and restructure what the capital stack looks like, we'll aim to do it at that time. Or we decide, hey, we don't want to incur any of the sale costs. We don't want to incur any of the refinance or any of those costs, or like a cash out refi, really. We want to just try and extend the loan, keep what we have, and accept the distributions that it can make in its current state. So we're going through the math on those three things right there. That requires us to spend a lot of time talking with our lenders about what the market is out there, and brokers on the sales side to determine, hey, what's the buying market look like out there for this type of deal. The reason we always have to ask brokers on that kind of stuff is we're not really buying deals that are 98% occupied. So we don't necessarily have a great sense of, hey, what is something that's full and stable going to transact for? We always want to go to market and see what those terms would be at that point. If the question is, what's a vacant, non-performing deal look like? We got some good answers. We know we know where that market lies. But fully occupied, stable, long-term lease stuff, there's always different buyers that are looking to get in that space. And it's much different than the who wants to buy the vacant office building conversation.
Right. And we have access, we're subscribers to CoStar. CoStar has a lot of great data that we utilize and leverage and compare to. But at the end of the day, the conversation with a broker is, it really guides that. For example, Johnson Square is, I think it's pushing 25% around autism and the autism school there. So there could be a strategic buyer that's looking for exposure to autism centers and that they want to expand this footprint, because all this tenant has done since we took it over is expand their footprint with us. So it could be an autism campus for someone's vision of it. So, and they might be willing to pay more than the rest of the market as well.
Yeah, that's really been one of our largest leasers of space this past year, was autism centers. So that's the game plan with Johnson Square. It's really a math equation. Once we have the answers, we will share that with all of the investors in Johnson Square and say, hey, these are the scenarios that we can outline right now. All of them take multiple months to execute. Even just selling a deal is going to take 4 months to do it, from getting all the listing stuff together, going to market, doing all the tours. So that's about a 4-month process. And same with the refinance process. They're both fairly equal on time frame of how we do it. So that's already in the works. We don't have the actual answer on what the debt rates are going to be or what it's going to look like, but we'll know here probably near the end of the first quarter what direction we can take with that and really what it looks like. We have a pretty rigorous buy versus hold versus refi model that we go through. So we'll share that with everyone in the Johnson Square deal as well. Okay, next question set here. Good old Midtown. So how do you plan to sell more buildings at Midtown, and what is our current loan there? Midtown, we've talked about this numerous times. The loan, at least. We bought 270,000 square feet up in Chattanooga. That's what this deal started at. And we had around a $17 million loan on the portfolio as a whole. Now, that's one where we did not have additional draw funds that would be advanced to us. So it limited what we could do on the renovation side. So instead of doing the whole property at once, we went building by building. And so now we've sold a few buildings, and we were trying to sell another one at the end of the fourth quarter. It just didn't happen. After that was probably like 5 months that we went back and forth with that potential buyer, and ultimately we're not at the negotiating table anymore. We were into the contract phase, but that has ended. So we'll look for a different buyer on that, but we still do plan. We're down to 219,000 square feet, and we plan to sell buildings one at a time. We have a unique building there that is a city government building that has one big suite. If we could lease it, it would be an excellent value creation opportunity on that deal. So we're looking at that one.
It would pay off almost all the remainder of the debt.
Yeah, we started with $17 million in debt, and we're down to $9.7 million in debt on the 219,000 square feet.
Right. If you guys remember, right, this deal has, the bank has really locked out the capital stack, so we can't make distributions. We really can't fund any future improvements. We have to use any cash flows towards improving the buildings. So we can't make distributions here. Our goal here is really just to sell buildings off one by one, pay off this lender, and then reassess the really what's left of the portfolio at that point.
Yep. I mean, if we can get down to around 155,000 square feet with no debt, we'll be in a really good spot.
With an average basis of barely $50 a square foot.
Yeah.
We bought for 78. We're selling in the 100s on the high end, in the 130, 140 range, on the low end, right around 100. Again, our basis is 78 a square foot. So as we realize that capital, we're paying more off in debt than we have on debt. So we place about $50 a square foot in debt, but every time we sell a building for say 100, we're paying off twice the amount of debt that we put on per square foot.
Or 120, 130, we're paying off a lot.
A lot more.
Yeah. So that's why we're able to pay down the debt here so aggressively. And overall, from a deal standpoint, it's working. From our original plan was to make distributions from this deal because we bought a deal that was occupied. It did have some cash flow. We didn't get on a per square foot basis a whole ton of debt. However, we know that is not what happened. That part is frustrating. But we are still making good value on what we're doing and how we're executing the plan there.
Mm-hmm.
Okay. See. So question here back on Johnson Square. If it's 98% occupied, why does it have such limited distributions? And the answer is really, we had a bunch of CapEx work that we did on the loan here or on the property. And we had the choice of, do we take out additional debt to make distributions with that debt, or do we not take out the final piece of the loan? And knowing that the loan was coming up and we're already going to work on either going through that refinance or sale situation, we didn't want to incur the extra interest expense of that, which was roughly about $500,000 that we could have drawn on the loan. So we didn't do that draw in the second quarter of 2024. We're like, okay, we'll do this in the first half of 2025 and save that interest cost. So that's why we did it. And that then limited the distributions that could come from it. We wanted to be able to say, hey, we're 98%, we're full. We have months of track record showing that, and that can really put us in the best situation to get a loan, or it can put a prospective new buyer in the best situation because it has stable track record. But that's why I was unable to make distributions on that front. Okay, let's talk about the next question came in on Dawson Flex. So can you provide better guidance on how you'll address the significant differences between the budget and actual performance for Dawson Flex? So this is a good example. A lot of the times when we're trying to buy a bigger building, our number one game plan is to go in and divide it into smaller suites. When we look at what we're good at as an operating business, it's working with people that we can have direct correspondence with. So when we lease to a 5,000, 6,000 square foot, 3,000 square foot tenant, we're normally talking right to the decision maker on that lease. As the leases get larger and larger and larger, you're typically talking to a team of people and you're not quite sure like who's ultimately the decision maker and how this is going to go. At Dawson, we had the opportunity to work with an individual who also was planning to lease like 40,000 square feet. So it's the largest lease that we've signed to date, but they took an entire building and it required an extensive build out and length of time just to sign the lease. So that was much longer than we had anticipated. So really the biggest variance we had was time. We expected to lease this deal, get it going in 18 months, and it took us over 2 years to do that. And it might not seem like a huge variance, but 18 months to 2 years, 2.5 years is vastly different just in our carrying cost on the size of our note here and the operating costs associated with having a building with no revenue. However, getting that bigger tenant, getting a 10-year, getting a big lease out of them is highly valuable to the asset. So that's why we felt like that was the right choice. So, but we are definitely off track from budget because that is not what the plan was when we were going in. On the other half of that asset, we did sign a lease with one tenant that took another big chunk of space. Our original plan was divided up. We went in, we signed this lease with the tenant taking that space because they had minimal TI. However, after like 3 or 4 months, they stopped being able to pay the rent and moved out. So then we're back to square one, and we had to go divide up the suites and lease that space out. So now on a timeline standpoint, we're way behind our pro forma on that deal. So it really takes us to two situations, is figuring out, do we want to sell one building at a time based on leases that are there? It's full now. Everyone will be paying rent going into the second quarter, right? In the middle of the second quarter, everyone will be paying rent. However, we've got to see if we want to sell one individually, building by building. Do we want to refinance the whole thing together? Or are we okay with, look, we have the deferred pref. We will not be able to pay back that deferred pref just from current cash flow. But we will be able to make distributions going forwards on cash flow. So we really have to look at those three scenarios and see what we can do on that deal.
Yeah, I mean, the discussion with Dawson, that kind of bleeds into this is really the asset type and its location, is that there's such few properties like this available. They're not building new. The values of them keep going up. The rents keep going up substantially. And we, by selling it sooner than later, we would miss out on some substantial rent growth. This is kind of what we saw in apartments, right? It's like we had a lot of good years of 10+% rent growth, and we sold a lot in 2018, 2019, 2020. And really the most accelerated rent growth was really from 2020 to 2022. And we missed out on that really opportunity by selling too soon. Now, we did fine. We're not complaining. It's more that there was a missed opportunity. So we're looking at really this part of the market as well and say, okay, the rent growth is still substantial in this market, and they're not putting on more supply. There's no place to put any additional supply. So let's keep an eye at kind of the macro level view as well.
Yeah, and there's not going to be zoning changes to enable this kind of stuff to be built.
Yeah, nobody's going to a neighbor and say, hey, I'm going to put an industrial building next to your house.
Yeah.
Yeah.
So we definitely feel like these have great long-term value and cash flow situations. It's just, how long does it take us to get stabilized? And then once it is stabilized, are we satisfied with what it can produce and holding that going forwards? And again, that just comes back to going through the math equation of what the broker opinion of values are and what the debt offers are that are out there. So that's really what we plan to do on Dawson. And really that's our cycle. It sounds a little bit very similar to Johnson Square, but that's our cycle. As we get into the stability standpoint, we have to assess what is the best long-term either value capture or cash flow creation method that's there. Okay. We're going into some of the other deals here, but question is, how is the TVTC performing in Chattanooga? And this is probably one of our nicest commercial or office assets that we have. And it's obviously up in Chattanooga, but it's fully occupied. It is performing. We continue to see the incremental rent bumps. We have pass-through a CAM charges here. So we have all the things we like to see. It's been able to make partial distributions. It has not been able to make full distributions of the preferred return. And we have a significant amount of money in reserves here, specifically with the lender. It's right now I have around $1.3 million that are in the reserve account, but our loan is at 4.1% through 2029. Most of our leases go till 2028, 2029. So we like the deal. It's performing well. It is probably not in a position until we refinance out of that loan to make full distributions. We have greater than our, even according to our reserve requirements, it's greater, but it's not our call with the bank loan on that one.
And what's unique about this deal, it's a very traditional suburban office building, meaning like 2-story with a lot of service parking. What's unique about it is that it's in downtown Chattanooga. So this is one of the only buildings that has 60,000 square foot floor plates. That's why the city of Tennessee, or the city of Chattanooga and the state of Tennessee, want to be there, because they want all their people on one floor. And they also want service parking, which really doesn't exist in downtown Chattanooga. So we have another building, the Lupton, in downtown. And, one of the biggest discussions on it with prospective tenants is where I'm going to park. And
because it's very much urban.
Very urban. Yeah. And there's parking garages all over downtown, but there's none allocated to specific buildings. And there's a cost associated with that. So part of the negotiation is, how many parking spots will you buy for me? So TVDC is unique that it has its own parking lot, and there's plenty
Gated
of parking, and it's gated, and it's right in the downtown.
Other question that ties right into that is, are we likely to hold the Lupton building until 2029? Realistically, all of our QOZ assets, we're going to look to turn those over prior to 2029. That's our goal there, to really realize that value and get it into another asset long term. So, but again, we've got a lot of leasing activity at the Lupton, which is exciting. Signed a bunch of leases there.
We have tenants in there. You know, it's a vibrant building, so it's pretty exciting to see that movement.
Yeah, but yeah, I think, you know, even the premise of the QOZ, our average hold term has been 4.5 years across 125 plus deals. The QOZ fund, the idea of holding a specific asset for 10 plus years, it's a long run. But the QOZ fund enables deals to be turned over and transacted within. So, we plan to most likely sell those deals and flip them over in the QOZ. The next question was on the hub in Milton. So, how is the conversion of building 200 going, and when do you expect this to be completed? And any update on what the city is doing? So, kind of start with the second half of that question first. And the city they're doing two things. One, they're building connecting pathways from all the properties that are right there. We signed an easement deal with them about a month ago that's supposed to close in February. That gives them some smaller pieces of land around our property that they can build larger sidewalks to be able to connect all the different foot traffic walking access points into the park that they're building right next to our complex. So they're building what looks like it's going to be a large baseball complex, with a lot of sports fields there. So that is the city's plan. They're planning to break ground this year, and they're very highly motivated to get things moving.
We had a great discussion with Mayor Payne Jamison and in Milton and it was actually consistent with the mayor of Brookhaven as well, Mayor Park, which is it seems like the cities are on kind of a land acquisition mode to just get more city parks and build more connectivity throughout their city. So we're excited to be part of that. We're excited to help them connect all their dots.
Yeah. The connectivity and parks were like the number one driver of what they're trying to do.
Yeah, both of them.
So that park is definitely going to get built. It's going to be great for our property. So, but that means we don't necessarily want to go full steam ahead in doing something. We want to make sure that it can be as synergistic as possible with the park that's there. So the first project we have was, we have one building that was fully vacant, the 200 building. So we're able to submit that building through the permitting process and get it divided into smaller suites. The building's enormous. So we're going to divide it down into like our 3,000 to 5,000 square foot suites, our typical game plan there. We got 180,000 square feet total. So there's a lot of room. On the other side of the spectrum, though, we signed a fairly big lease with FEMA, who's in there kind of in a short-term situation, but they're there, they're paying the rent now. So that part is excellent. Gives us some additional free cash flow while we go through the the permitting process. So our game plan is really, we build out the suites, we submit that for permitting to make sure that this can be done. They go through everything like sprinklers, access points, parking, they go through all that stuff. Once we get that approved, we'll do the white box stuff of it. But we submitted that. We have our permits ready to go on the first section of it. And we're going to be swinging hammers there soon, which is good. And we've also had lots of interest in renting the suites up there. So,
and what's a nice comparison too is the property that we're at right now, Formflex, is about a year ahead of the hub. So we are kind of on the tail end, meaning that all the permits are, for the most part, closing out. The spaces are all built out. Tenants are starting to move in. We just had a pest control company with, how many trucks are out there?
There's like 8-10 trucks out there that
all
they're putting their stickers on them.
Yeah, their whole fleet's out here. And so we're kind of on the tail end of that build out and the tenants moving in. So it's exciting to see that. We're using a similar playbook, but a faster delivery playbook for the hub.
Yeah. So we expect to have that building this year. So in 2025, That's our target there. The other buildings there, though, we'll move to those as we finish this one. We're really just going like suites at a time to do it. The other ones also have tenants in them, so there's a little bit of workaround when we're going right up next to someone's space on that one. Okay, next question was on Davis Circle. And the question on Davis Circle is really just, when do we expect distributions to happen? So if we go back to the beginning on Davis Circle, our game plan for that project, it was a 2-tenant building. So there were 2 tenants in it. One was a very large, like you look at it like, wow, there's a big operation going on here. And the other one was more of the mom and pop tenant. And you're kind of like, what's happening here? So 2 very different types of tenants. Well, the mom and pop one, the whole plan was we didn't really think that lease was going to work long term or perform. So that was probably one of the largest evictions that we have ever gone through. Getting everything out. It was the space was jam packed. So we completed that, and now we're touring with the neighbor to see, hey, you want to take this full space so you have a full building? That's really for us the best value situation. Or if they don't want to do it, they have not signed anything. They've looked at it 5 or 6 times at this point. We were originally talking directly with the owner and the operator, and then they brought in a leasing broker on their side. So that's definitely making it take a while longer. That whole overall, it'll probably take us 7 to 8 months of that lease discussion with them to see if they want to take the space. When we kind of guesstimate going into these deals, we don't ever plan for 8 months on a lease negotiation. It's very long. So at the same time, though, we're looking at, can we just lease the space to someone else that wants to take that side? And we'll really do whichever one come first and move the fastest so we can get everything stabilized. Once it's stable, once we know what those lease terms are going to be, it kind of goes back to the same decision point that we talked about before, which is, do we refinance? Do we hold with the distributions it can create from where it's currently at? We expected the whole process to take about 2 years from day one. So we're roughly on track with that, depending on how quickly this current tenant decides if they want to take the space or not. Yeah, seeing if there's any other questions on the commercial asset stuff. So one thing we do want to talk about just on the commercial space as a whole, things feel very positive. So there's not a lot of new space that's being added to anything. If you look at that just from office or the light industrial or flex, there's no real space being added anywhere. We have some charts too, like almost all of the cities that we really compare, even if we don't have anything in Dallas. We look at Dallas, we look at all the other cities, look at Nashville or Charlotte or Atlanta, and purely office rents are up. So there is demand for stuff that's out there. We're seeing a lot more of everything seems like it's back to being in the office. There's a big push of the federal government too. Like they're very much like they're back in the office now for the first time in almost 5 years that they're there. And then also just the general theme of call it re-domestication of business happening back into the U.S. With not a lot of supply, it seems like those things are all aiming in the right direction for commercial real estate to perform very well.
Right. And one of the articles, I think we talked about this in our end of quarter, review, but one of the articles that we were referencing is that the majority I think there's roughly 1 billion square feet of commercial space that's vacant. And the majority of that, let's round it to 600 million square feet of vacant commercial space, is in less than 7% of the product, meaning that there's a ton of defunct older buildings that just can't be occupied, and they're just sitting there vacant, waiting to be torn down. I have a friend that built industrial buildings. He has a 300,000 square foot office building that he's tearing down. It's sitting there vacant. So right now on paper, it looks like they're 300,000 square foot vacant in that market that it's in, but in reality, it's being torn down. So the majority of office stock that can be rented is being rented. Yeah,
and it's probably losing overall square footage.
Yes.
So those seem like things are going in the right direction. We're seeing rent growth, constricted supply, and two demand drivers that are really pushing usage of the space.
Right. Yeah. I mean, nationally, the office vacancy is about 17%. So say 83% occupied, but over half that space is in defunct buildings. That's Airbnb.
That quick math.
Yeah. So we're basically, in terms of inhabitable buildings or useful buildings, occupancy is in the low 90s.
Yeah. I mean, remember that building we toured in downtown Atlanta?
Yeah. Nothing you'd beat on that.
It was a 60-story building with no parking. That was classic office.
From the what?
70s.
Yeah. Late 70s.
Almost totally vacant. Yeah. We're like, I don't know if we could do anything with it for free.
Yeah, it was 500,000 square feet, and they only wanted $40-$50 a square foot for it, and we had no idea what to do. It was a great basis for what you were getting, but there was
the basis per square foot sounds great, but there really wasn't. What can you even do with this?
Yeah,
it was so defunct.
Yeah, we figured we needed like
it's $200
to $300 a square foot to put into it to do anything with it. Yeah. We were better off by just buying another building.
Yes. So, I mean, there's definitely some office and definitely some commercial buildings that are in really bad shape. They're probably going to stay that way, while as anything else that can be used and can have something done with it, like it's going to, that's what we're looking at buying, and it's performed pretty well from a standpoint of we can get it occupied, we can lease it, and therefore we're in a situation to see if we want to hold this thing or sell it and realize the value.
Right.
Question here, where do you think the next opportunities are, and what do you see on upcoming deals? We're going to talk about apartments next, but if we think about just upcoming opportunities, we're seeing a lot of opportunity in the debt space that we talked about. We're going to have a bunch of those deals that are coming out end of the first quarter here.
Yeah. There's some of these. Yeah.
We did we bought a couple of these Dollar Generals that we think we got a really high cap rates compared to where the market was at. We like those. And I mean, we're still if we can find single story buildings with surface parking,
in suburban locations.
Yeah.
Where really it's
that have good access,
infill. Yeah.
That are infill. It's we would love to buy more of those. There just aren't that many, quite frankly. Something it almost doesn't even exist in cities like Nashville because they didn't have the urban sprawl happen for this thing to even get created.
Right.
We've looked a ton in Charlotte. We haven't really found any.
Yeah, Charlotte has more traditional office, which is more the high-rise stuff, and then traditional industrial. What it doesn't really have is a single-story office kind of hybrid product that leases so well to really both type of tenants. There's not that much product of it. And we've been hunting for it, but we have a full-time person up there hunting for it.
Yeah, I mean, we got the North Graham building that we have up there, which is in the QSE fund, which is one that's we got a single-story building next to a great development, and it was there was a challenge to get it all done.
Right.
That's one where we did the deal. Went through all of our construction and permitting and everything, and then after we finished, they changed the zoning. So we don't really can't stop it. So that was there's some challenges and just how all that plays out. But opportunities, those are really the three main areas we're looking at, right? So debt, retail, and the single story assets that are out there, whether we convert them to office, medical, flex, based on where it is, that dictates what we'll use it for. But that's really the best opportunities we see for value in the market.
Yes.
So two of those are cash flow, debt and retail. The single story is really value add. So it's not really a distribution game until we get it stabilized. Then we decide if we're holding it or refinancing or selling or what we're going to do with it.
Onto apartments?
Onto residential. As we're mixing in mobile homes and apartments together. So residential segment here again. If there are any questions on these, just drop them in the comments. Hopefully we're getting to them as they come in. So overall, I would say the feedback that we heard from the fourth quarter on the apartment side and residential was why do we not make distributions, and are these deals failing? So that was the majority of what we heard just from the fourth quarter. All of our residential deals made distributions for the year, except for City View. That's the only deal we had that didn't make distributions. Most distributions for the year range between 4 to 7%. what do you call it? East side had profit sharing. So we have one that was over 8% just on pure cash flow. Or that's a 10 pref, so no, 8.5%, but not the 10 pref. So almost all of our deals did make distributions this year. And the fourth quarter was probably the most challenging operational cost quarter that we've ever had. Deals like Amberwood. I mean, we started talking about taxes and insurance like 2 years ago. Felt like a broken record. I feel like we've talked about it so much. And that's really why we started looking at debt. We started looking at retail, was because we saw that kind of tidal wave of issues coming. And I think it's summed up perfectly in Amberwood. I mean, we made distributions this year in Amberwood. We're building our reserves there, but our taxes went from 18,000 a year to 120,000 a year, and we appealed them, got them down to 68,000 a year, but then had to pay a $30,000 fee to get them reduced. So it's like, it's a monumental like roller coaster of cost swing and some of my emotions, but we're dealing with that, to going through how we can do it. Now, two things can happen because of that. We gotta have a deal that just gets wrecked because expenses get too high, or we can have a deal that the market in that area supports increasing rents that much, and the actual value of everything in that area goes up significantly because of it. Amberwood, for example, I mean, the neighborhood is fantastic. It's one of the most expensive in-town neighborhoods now, and rapidly growing. So we like that deal simply because we are able to increase rents there. We are able to keep things going. Now, definitely missed on what we thought was going to happen with taxes, but we feel like we're better positioned. You know, we're going to be more aggressive on our inflation estimates for 2025 for that. But all of our deals really, they are cash flowing, they are making distributions, and we are paying down principal. So they're in good shape. It's doing a lot better than most deals, I think, that are like the 21, 22 class vintage of acquisitions are not making a lot of distributions from what we're seeing in the market.
I mean, we went from a 7-8 year run where income was rising 10% plus a year, and expenses were flat to 1 or 2% increases, to in the last really 24 to 30 months, income flat, just 0 to 1.
Yeah, the market.
Yeah, from a market standpoint, we're still seeing income increases, but the market is seeing basically flat income, and expenses are growing at 10 to 15% a year. We're on the better part of 3 years, and taxes and insurance are up 100+% year over year. So it's been rough, especially for the guys that purchased assuming the past performance.
If you purchase assuming the past, it's definitely a challenge.
Yeah, so we're in a good position with long-term fixed debt, and our basis being a half to a third of what people are paying for in the market. But we're also taking a really conservative approach to make sure we can afford that next increase. So that's why we're tightened up distributions when we have to.
Yeah, like on Amber, we did have a question here. It's like, hey, would it be better to sell this property and just cash out, or reinvest into another deal that's producing a higher IRR? And when we look at this deal and the location that it's in, we were able to get 12% rent growth there this year. The market in Atlanta was negative 1.7%. So we feel like we're definitely drastically outperforming the market. Now, 12% isn't good considering taxes went up 5x. So we didn't see that. We knew they were going to go up. We did not expect them to go up that much. But we feel like we will be able to capture continued revenue gains in 2025. And when we look at deals, if we're able to maintain or expand our operating margins, we're always optimistic to hold those deals because we know they're performing well and improving. The area is improving. We're just going to see continued value growth. When it goes the other way and we see margin compression, that's when we look to exit a deal. That's what we did with Kingstown, which we sold. And that one, because we were able to hold and we were able to maintain margin for so long until the very end, that's where we decided to exit. We still had almost a 7x on our equity there.
Yeah.
So it was a fantastic deal. And that happened because we were able to ride the wave of how that neighborhood was doing. And Amberwood is in an even better neighborhood and performing well. So there we think we will continue to hold residential assets unless we see margin compression.
Right. And in talking about margin compression or expansions, talking about our mobile home parks, right? It's like we're still seeing significant expansion on really all of our mobile home assets as NOI continues to grow. Rent growth continues, the stability is there, the retention's there, so our expenses are under control. We're doing incredibly well.
But even part of that process, though, we do have to take our deals as we have loans that are coming due even 3 years out. We still have to go talk to brokers, be like, hey, what's the market value of this position right here? And we're always looking to say, okay, what's the best investment decision we can make for the deal? We're not just like, oh, we feel like holding this or we don't feel like holding it. We have to go through and do that math to figure out what's the best situation. When we look at a deal like CityView, we didn't make any distributions this year. And the question was that came in on that of like, what is the plan to make distributions? Well, revenue at CityView was up almost 8% this year, grew a little over $140,000 a year, but our expenses were up 16%. So expense growth outpaced revenue growth, which made it really challenging to make any distribution. All of that expense growth wasn't taxes and insurance, that was flat there. It was interior and exterior repairs that we had to do on the property. So that really was our cost driver there. And we have to look at those situations and be like, okay, were these one-time events or do we expect that to continue indefinitely? In 2025 at CityView, we know we have not in the building, but in the outside of the building, in the ground, plumbing drains that we're working on doing one building at a time as our team goes through them. So we're looking at making those improvements right now. And that's the plan for 2025 on that deal. If we simply outsourced all of those, it would probably cost us 2 to 3 times as much. So we're not looking to just go below that budget. We're doing them one at a time as our team works through them. Okay, I don't see any other questions on the residential side, but our general plan on residential in 2025 is to do our comparisons as our loans come due. We have a lot of fixed rate debt. That's what's helped us perform so well on those deals for many years, was the fact that we did long-term fixed rate debt. Most of our debt on apartments was out 10 years fixed rate. So that's really been a key driver in helping us perform there. Investment thesis kind of going forwards on the apartments. Like, we don't necessarily see a great opportunity to buy stuff right now. We'd like to. We've been saying that for years, though. We haven't bought anything since 2019 on the residential side, mainly because when we use our knowledge or our thought that, hey, we're going to see lower rents and higher expenses, makes things hard to pencil.
The simple math is, if rewind, they say 2013, 2014, where we're buying the bulk, rents have gone up 2x from then, but values have gone up 5x. It's just that simple math. It's like, we're not buying at the same cap rates anymore. We're stabilizing in the 8, 9, 10% cap rates. And now you buy a value add apartment complex to stabilize around a 5 cap, maybe a 6 cap, depending on the location, but you're definitely not getting to a 7. And that's all pro forma. That's all on paper, meaning that there's a high probability that you could miss that. Yep. So it's just the margins are just too tight.
Maybe. Well, we used to look at that stuff just based on gross rent.
Right.
It was just, hey, what are we paying per unit? What are we paying for revenue that's coming in the door? What we can get in revenue. So yeah, we got to eat all, the residential side, all the cost exposure comes to the landlord, and that's a challenge right now in the current market.
Right.
Yeah. That wraps up all the questions that we had that were submitted in here. So we're happy to go through any more questions that people have on any of the asset classes if you have anything. But for now, that concludes our fourth quarter Q&A. So very much appreciate everyone joining in and asking questions. Hopefully we provide some insight into how we're operating and what is helpful on these deals. We'll stay here for a couple minutes and see if you do have any questions. And if you do, just put them right in the Q&A thing. We can talk through them. So.
And keep an eye out for our upcoming events. I believe February 20th. Lisa's giving me a head nod right now. So February 20th, we're doing a family investing event. So bring your kind of teenage and older kids, and we're talking about how to invest with your kids, how to engage them in the story, how to learn about real estate with your family, and make it like a family legacy investment.
Yeah. So that's that's the end of February here.
Mm-hmm.
Yeah, and then X Golf.
Yeah, X Golf in West Palm.
If you're in Florida.
Yeah, you're in Florida. It'll be fun. The weather's great.
It's going to be indoors. The weather's always great.
Well, yeah,
indoors.
that's a good point.
All right, we'll stick around for a couple minutes here, everyone. But thank you very much for joining us today. We appreciate taking the time out to go through this stuff with you. So thank you. Good. See if anything else comes through.
Yes. Are there Super Bowl teams yet? Like, or
I mean, it's final.
the Kansas City? Ah, okay. All right.
The old Eagles
when
coach,
is that?
the new Eagles coach. I don't know. Should know when that is.
Like, to me, when
Soonish.
they leave college and they just don't exist anymore.
Because they're not at Texas anymore.
Yeah, exactly.
We still got some people. Someone's thinking about putting a question and I can feel it. Maybe not. All righty. That sounds like a no.
Yep.
Okay. Thanks, everyone that's
Thank
left.
you.
We appreciate it. Have a good rest of the day.